How are different investment income types taxed in the US? Imagine earning money from your investments and wondering how much of that will go to taxes. Knowing how each type of investment income is taxed can help you plan better. Let's break down the main types of investment income and how they are taxed in the United States. Interest income is money earned from savings accounts, bonds, and other interest-bearing investments. This income is taxed as ordinary income, which means it is subject to your federal income tax rate. These rates can range from 10% to 37% depending on your total taxable income. Dividends are payments made by companies to their shareholders. There are two kinds of dividends. Qualified dividends are taxed at lower long-term capital gains rates, which are 0%, 15%, or 20%. Non-qualified dividends are taxed as ordinary income, just like interest. Capital gains come from selling assets like stocks, bonds, or real estate. If you sell an asset after holding it for 1 year or less, it is called a short-term capital gain and taxed at your regular income tax rates. If you hold the asset for more than 1 year, it is a long-term capital gain. Long-term gains are taxed at reduced rates of 0%, 15%, or 20%, depending on your income. For example, in 2025, single filers with taxable income up to $48,350 pay 0% on long-term gains. Those with income above $533,400 pay 20%. Rental income and royalties are also taxed as ordinary income. However, there are special rules for these types of income. For instance, you can deduct depreciation on rental property, which can lower your taxable rental income. But you need to be aware of passive activity loss rules that limit how much loss you can claim in a year. In addition to regular taxes, there is a 3.8% net investment income tax. This tax applies if your modified adjusted gross income exceeds certain thresholds. For married couples filing jointly, the threshold is $250,000. For single filers, it is $100,000. For married filing separately, it is $125,000. The tax applies to the lesser of your net investment income or the amount your income exceeds the threshold. This tax affects interest, dividends, capital gains, rental income, and other investment earnings. For Asian American investors, it is smart to keep track of your income levels to see if you might owe the net investment income tax. Understanding the difference between short-term and long-term capital gains can help you plan when to sell assets for lower taxes. Using tax-advantaged accounts like individual retirement accounts or employer-sponsored retirement plans can also help defer or reduce taxes on investment income. In summary, the way investment income is taxed in the United States depends on the type of income and your overall income level. Ordinary income rates apply to interest and non-qualified dividends, while qualified dividends and long-term capital gains enjoy lower rates. The net investment income tax adds an extra layer for high earners. Proper planning can help you keep more of your earnings and make the most of your investments.